Okay. Can everyone hear me? That's great. So, good morning, and I'm pleased to be here and chairing the first in-depth panel of today's conference on sustainable investment, which takes some of the big picture themes which you heard about before the break and goes into more depth and detail. And I'm pleased to welcome three distinguished panelists here alongside me. Their detailed bios are included in the booklet, and I know that each of them has some very interesting materials and thoughts to share, which provide a framework around how we might look at different categories of sustainable investment, how these strategies have performed empirically, and what the potential might be going forward, both in terms of the wider market and also specifically in the Indian context. So before starting the presentations, I wanted to take the prerogative of the chair to make three observations by way of context, which echoes some of the sentiments which you heard in the opening session. So firstly, sustainable investment is not a fashion or a fad which will eventually fizzle out. It's a secular or a meta-trend which is here for good. And you only have to look at the large and growing number of signatories to the UN-inspired principles of responsible investment and the assets under management which they now cover to see this trend. And I know that the speakers this morning will be highlighting this data in their remarks. Secondly, this is part of a much broader shift from shareholder primacy to stakeholder primacy. So whilst the economist Milton Friedman famously said, "The business of business is business," that purist view of value maximization has shifted to the triple bottom line of people and planet as well as profit. This shift was reinforced last year by none other than the CEO of the world's largest asset manager, BlackRock, Larry Fink, when he wrote to corporate CEOs saying to prosper over time, every company must not only deliver financial performance, but also show how it makes a positive contribution to society. Which leads to my third and final observation, that the issue of calibrating and measuring impact beyond profit is the biggest elephant in the room. And there are no universally accepted standards for measuring the triple bottom line. But this is something which will evolve over time as we rise to the challenge and will no doubt provide many of the discussion points this morning. So with those thoughts, let me first ask Tatiana Boroditskaya of UBS to kick off with a presentation which provides a helpful introduction to some of the terminology and concepts which we have been discussing. Tatiana.
Good morning, ladies and gentlemen, and thank you very much, Lord Gadhia, for your very warm welcome to our panel. So today I'd like to talk more about sustainable investing. Within the last few years, this asset class became mainstream. It has grown very significantly in size and in importance for many investors and issuers. And within this asset class, we distinguish a number of key strategies. As you've seen on the slide, the first one is exclusion, whereby investor actively avoids certain companies or sectors which are not aligned with their values. The second strategy that one can adopt is ESG integration. Here, investor actively seeks incorporating ESG considerations in a traditional investment process to reach higher or to improve their risk-return characteristics of their portfolios. And finally, and very interestingly, we have impact investing, whereby investor looks to achieve targeted, measured social and environmental impact alongside financial return. But how actually your investment can make an impact? And here in the chart, you could see 3 ways to do that. First one, and the most straightforward one, is directly financing specific projects or companies that are likely, in investors' view, to bring a specific positive impact. Second one is stewardship. And here, if you are an investor in a particular company or project, you would be engaging directly with the company's management to achieve measured and positive societal and environmental results. And finally, you can also engage in signaling, whereby as investor, you either buy or avoid certain companies or get involved in certain industries to signal to the whole market that ESG characteristics and considerations do really matter. So when we look at it at UBS, and when we look at sustainable investing, we see this as an opportunity to combine financial, personal, and global values. And when we look at global values, we are looking at projects and ideas that could help attain 17 UN Sustainable Development Goals. But as investor, when you look at all of these things, what you really want to know is how investable is this growing and evolving asset class. And here we have some data from Global Sustainable Investment Alliance from the start of 2018, where the global assets which are invested sustainably reached $31 trillion, which is actually around 40% of the total value of largest stock exchange. So that is non-negligible, that is a mainstream asset class. So what has been behind such rapid growth of this asset class? Let's look at it from the perspective of companies and also from perspective of investors. If you are a business owner, what would you like to achieve? One thing you want is to gain competitive advantage. And in our view, if you put sustainability at the heart of what you do in your business, you can achieve just that. And that is particularly going to become important in years to come, as we expect many companies, many countries to pay more and more attention to attaining UN SDGs, and therefore putting more and more regulatory oversight and regulatory responsibility on companies in relation to sustainability. Of course, if you are putting sustainability at the heart of your business, you could think of potentially better operating performance. You can think of potentially improving your cost of capital as well as relationship with your stakeholders. On the other hand, if a company fails to do just that, you can think of repercussions such as regulatory fines or consumer boycotts or avoidance of your financial instruments issued by a company by ESG-minded investors, which is our exclusion strategy we just discussed. Let's look at investors. There could be various reasons why you as an investor would be motivated to get involved in sustainability field. Let's just name a few. Of course, you potentially want to align your own values with the way you invest. You can maybe capture innovation and mega trends. And of course, as Lord Gadhia just mentioned, sustainability is one of the sort of more longer-term trends that we are seeing here. And another thing you might want to do is to improve risk-return characteristics of your portfolio. That is something you might also want to achieve. And speaking about financial returns, there have been actually a growing body of academic literature which looks at how sustainability and sustainability factors affect performance of your investments. And here I'm just quoting one of many studies which was done at the University of Hamburg in 2017, which showed that indeed, if you look at over 2,000 empirical studies of this particular question, there is a non-negligible correlation between ESG and financial performance, and in most cases it improves or doesn't detriment them. So that is just what we have here. Now, as an investor, you want to have a little bit more than just a number of academic studies. You want to see at some specific instruments and be able to compare your performance in that instrument versus non-sustainable instrument, or traditional instrument rather. So what we can do here is we can look at green bonds. Green bonds are, as we've heard this morning, is a very important and fairly new instrument which is driving forward and funding the needs for various environmental projects. So in the way we look at green bond, it's your traditional bond, but with a green touch. By green touch, we mean that this bond is issued specifically to fund particular projects that will help achieve certain environmental objectives. And when we look at this and you compare a green bond and a non-green bond, a standard bond of the same issuer, you would expect to have identical claim on the company, identical credit risk, credit rating risk, and identical default risk, and therefore you should have the same yields. And on an index level here, we are comparing global corporate index to green bond index, which shows just that you have quite similar returns. On this chart, you have a number of data points showing the very explosive growth in the green bond universe. Starting from sort of 2013, 2014, where it was literally 20 billion or even less issued, we are actually having here quite explosive growth with the amount of the outstanding green bond debt globally at around $600 billion. And the latest data, which is even after September that we have on the chart, shows that the 2019 issuance of green debt year to date actually exceed what we've seen last year. So there's a clear impetus to that. Why do we see such dramatic growth? From investor side, if you're an investor and you want to get involved in sustainability, a fixed income investor, it might be quite a sort of easy way for you to get involved in terms of it's a pretty similar product and it's quite easy to understand and assess that. From an issue perspective, there are a number of things you can consider. So first of all, you would be gaining access to a fast-growing and significant audience of sustainable investors who are quite often long-term oriented. And that is, of course, would be particularly of interest for not only developed but also emerging market issues. Secondly, there are certain reputational benefits. And here, if you are an issuer who is doing this bond, you signal to the whole market, I'm very serious about sustainability, I'm taking it to the heart of my business, and that's what I'm doing, that's how I'm funding it. So that's, yet again, another benefit. When we look at sort of a future of the green bond market and where the new issues could come from and what can this be used for as well, we've actually recently done a study looking at various countries' commodity producers and looking at what they are doing to achieve their SDGs. And we found that quite a few of them actually need to do significantly more to achieve them. So in our view, green bonds can be seen as a key instrument to fund many projects that could be used to attain select SDGs. And obviously here, with quite a few countries needing to attain these SDGs, it could provide additional impetus to the green bond issuance globally. So thank you. Thank you very much.
Thank you, Tatiana. I think that was a very helpful context and a good prelude to our next speaker, which is a keynote address from Oguzhan Karakas of the Judge Business School at Cambridge University. Oguzhan.
Thanks very much for the kind introduction, and I would like to also thank the organizers for having me. Can you hear me and see me clearly? All right. What I will do is now, about within 15 minutes, I'll try to give you, in a zipped way, why we are talking so much about these ESG issues, what's the fundamental problem, and what's the solution that we are trying to tackle. And in relation with that, I'll tell you about two of my papers with my co-authors that are trying to be part of this solution. And what I am hoping is, once you understand what the problem is and what's the proposed solution, then this will open up basically all these nice linkages with what has been discussed and what will be discussed within this forum. Let me first start with this observation. In fact, Lord Gadhia made an excellent point, that when I was studying on this issue, these ESG issues, environmental social governance issues, or CSR, corporate social responsibility, or SRI, socially responsible investing, these are all kind of referring to the similar concept with different kind of nuanced differences. Well, 15 years ago, this wasn't that popular. At the time, I did my PhD at London Business School. I went to the Boston College as my first job. And then I was presenting the paper that I will show you today. And I have to say, half of the audience was very negative about why I am studying on this topic and whether it really matters. And I was telling them that, look, this is coming like a tsunami. After 5-10 years, all of you will end up basically working on this. And it's good to be on the right side of the history. And I want to basically emphasize, this is the letter that Lord Gadhia touched upon. The CEO of BlackRock last year basically told the companies that they are invested in that they should just not only care about the profit, but they should have a sense of purpose. And this year, Business Roundtable had this statement on the purpose of a corporation. It's very carefully written. I want to highlight a few issues over there. They are saying that basically they commit to delivering value to our customers. They want to invest in our employees. They deal fairly and ethically with our suppliers. They support the communities in which we work, and they generate long-term value for shareholders. Now, this is a tectonic shift because the previous, basically, objective was just creating value for shareholders and perhaps, caring a little bit about the customers because it serves the creating value for the shareholders. Now, it's not only creating value for shareholders, but creating long-term value for shareholders, plus caring for about other stakeholders. And this now brings me to the core of the problem. And I hope all of you on the very back can hear and see me. Let me try to stylize the very simple, basically, the model of how the capitalistic market the world works. There are two pillars. The first pillar is the market. And this, famously, basically quoted idea, this invisible hand of the market is working in such a way that every individual within this, basically, market acts selfishly to maximize their welfare. But then through this magic of frictionless trading of the markets, which brings this decentralized information and preferences all around the world to basically one number, which is the price, if you like, and everybody basically acting in a way that they will be only doing positive NPV projects, they will be only creating value. Interestingly, they create a collective benefit. And this basically increases the welfare of the society. It's kind of ironically, even if you are selfish by yourself, if everybody acts in a way that they only do things that create value through the trading, this will basically make the society better. And that's going to basically use the resources, the limited resources, in the most efficient way. That's the famous second welfare theorem of economics. So far, so good? Now, there is some part that we omitted. That's the second pillar, which is going to be dealing with it. Well, if you think the market as a machine that's producing some products, some services in a very efficient way, well, it also has some byproducts. In economics, we call them externalities. Now, you may have positive externalities, such as you stay in a villa, and then your neighbor puts some rose in their garden. It looks beautiful, it smells nice to you as well, you enjoy. You get this positive externality from them. But what we are more worried about is the negative externalities. Well, in environmental case, this could be the case that when you're producing some products, you may be polluting the river, the air, etc. Or from the social part, you may be basically creating some income inequality among people. You may be exploiting some child labor, etc. Whose job to fix these things? Well, it's the second pillar, which I will call the visible hand of the government. Okay? The market very efficiently produces these products and services. The government's job is to fix these externalities. this is where we hit the wall. Because was it popular in India, this cartoon, Tom and Jerry? The mouse and the cat is exactly basically what you're seeing here. Market being the mouse, if I can make the analogy, it's very cunning. And the government trying to catch this mouse is always kind of falling a little bit behind because it's inherently not as agile in catching it. And this is kind of a game that keeps continuing. And this is the part where I want to emphasize Lord Gadhia's point. His second point was an excellent point. Because I want you to understand why governments are, in general, less effective than the markets. Is there something fundamentally wrong with the governments? No. What makes the market super efficient is very simple objective of value maximization. If you have only one objective, like this blinded horse, then it's much easier to be efficient, and it's also much easier to be benchmarked according to certain criteria. The governments, as I understand from the term politics, has multiple objectives all around the world. Once you have multiple objectives, then it's very difficult to be as efficient because you have many things that's wobbling around. This is where the problem is. Basically, over time, the markets became more and more efficient. The machine is working quite well, but the second pillar is not able to catch up with it very efficiently. Is this clear so far? All right, now what's the solution that has been proposed? The solution is, well, if the markets are that efficient, why don't they do some of the jobs that basically were ascribed to the government? Why don't they do things that will basically in-house deal with some of these externalities? If I can make the analogy, if everybody basically cleans up in front of their shops, then the municipality's job is just to keep the main road clean, and everything will be much more efficient and less costly. And that's why, when you now look at all the companies around the world, there is an emphasis on corporate social responsibility. There's a team for corporate social responsibility. I just want you basically to understand where this is all coming from. Now, but this solution itself is also opening up some other potential worries. And this is why the Friedman was very kind of a purist in that sense, because if the market ends up doing some of the things that the government is supposed to do, then the worry is that we can also break the machine, the market itself, because they might end up having multiple objectives, and again, we go back to basically even behind where we were. And therefore, the key issue is to achieve and to keep still shareholder value maximization, but keeping also other stakeholders in mind. And for that, we have essentially two tools. In fact, it's a very famous concept by Sherman called exit, voice, and loyalty. And when people are confronted with difficulties, they have essentially two options. You either exit or you stay and you fight, which is the voice. In financial mechanisms, that's basically divestment, Wall Street walk, you vote with your feet, versus you vote with your hands, which is the voice. And what I want to emphasize in this talk, in the remaining of the time, is more on the voice side, on the engagement side. The reason is because, in fact, this using exit, divestment versus engagement, is in fact a bit of an art. And you should basically use these tools at the optimal way. But one thing I want to basically emphasize is that the divestment itself has some other basically implications which may not necessarily always be very desirable. Now, coming from University of Cambridge, many of our students are very worried about the University of Cambridge's endowment invested in oil funds. And as with the youth, I think, energy, they say, well, we should divest from them right away. They changed themselves to the Senate House, make some basically objections on how these funds should be invested in. But the point basically we are trying to make is that, well, we also care about ESG issues. But once you divest from something, that means you sell it. Well, there's a buyer on the other side. And if there's those basic investors that are buying these assets that you're willing to sell, they are less likely to care about the things that are, first of all, that's on the table. That's number one. And when you sell these basic assets, you lose an important power, which is your vote, your voice in these companies. And that's why I would like to focus more on the engagement side and show you these two papers of mine with Elroy Dimson, who is also my colleague at Judge Business School, and he used to be at London Business School before, and Shi Li, who is at the London School of Economics. This paper called Active Ownership is a quite popular paper now, not only in academia, but in practice. I think for various reasons, but perhaps for this very famous chart that it shows. What basically it's talking about is when you engage with the companies for environment, social, and governance issues. This is the data we got from a large UK asset manager, and we want to see what's the impact of that. This company gave us all their letters, emails, telephone calls, everything in the engagement sequences, and we basically wanted to analyze when they engage certain companies for environment and social particular issues, whether this creates any positive impact. For this study, we only focused on the US public companies. And just to give you a sense, if it is an environmental issue, they may say, well, look, in your Malaysian factory, you're polluting the rivers, stop doing that. Otherwise, we will divest from you, or we will show you a yellow card in the shareholder meetings, which means we will abstain from voting in favor of you, or we will show you a red card if you're following football like myself, which is voting against you in the management. There are different, basically, punishment mechanisms. For social issues, again, they may say that, well, we want you to pay attention to your employees and not use child labor, etc. If the company listens to that, then that's a success, a milestone. If not, then it's not. And what this graph is showing you, well, what is the impact of these engagements over time? And this is showing you the abnormal returns, if you like, this additional value that's created using these engagements. The red line is basically telling you that an engagement, which takes about a year or year and a half, therefore 12 or 18 months, is creating about 7 to 8% value if it is successful. And the green dashed line is showing you what happens if there is no success in these engagements. Well, nothing happens, at least there's no harm in engaging, at least according to this study. And the success happens in 1 out of 5 engagements. To be more precise, is 18% of the cases are successful. Therefore, if you blend them together, you come up with this blue, basically, line, which is saying that on average, these engagements are creating about an extra value of 2% for large firms. Just to put it into a context, are you familiar with hedge fund activism? This is the activism of the hedge funds that have been going on since 2000s and so on, to engage with the firms for particularly governance and business-related issues. And the number there, what's their impact? That's about 8%. What's this, what we call ESG activism creating? It's 2%. What's the difference between them? Well, the way I see hedge fund activism is a bit like a math teacher. They knock on the door of the company, or sometimes kick the door of the company and ask, what is 2 plus 3? And if you start wobbling, well, it's maybe 4 or 5 or 6 or 7. You're not the right answer. Well, then you should, divest from these projects. You should pay more dividends. Change your capital structure, spend more time with your family, etc. It's a very business-oriented math type, basically, solutions. Whereas ESG activism, as I am talking here, is a bit like music teachers. They try to put this harmony, infuse harmony into the company, and that's why it's very difficult. And I guess we will be talking about that, how to measure this. Because if I ask you what's a good music, you may all tell what it is, but if I ask you to describe it to me, it's very tough. And that's one of the challenges we are having regarding the environment and social issues. It's very difficult to agree on what exactly the metrics to capture. In this study, we also find that basically these increases in the stock prices are not only about just market, bubbles, but in fact, they are kind of supported with some real changes within the company. And the basically mechanisms are varied. One is basically, if you pay attention to environmental and social issues, first of all, your employees become much happier. I guess I see it from my friends who work in Google, for instance. They seem to be very happy and well-treated. They unlock, their imaginative power, and they become even more loyal to the company and perhaps become much more productive and create value. That's one channel, the employee channel. Second thing is, if you are paying attention to these issues, well, your customers like you. You can brag about it. You are a green company. And that creates basically extra sales, and it increases the profitability in the company. If you are a good company that pay attention to ESG that attracts long-term, what we call the universal owners, that don't necessarily care about what's going to happen in the next quarter, but they care about what's going to happen in the next 10 years or 100 years, such as pension plans, endowments, etc. That basically solves the myopia problem of the management. And this decreases the cost of capital of the firms and obviously increases the valuation. We even find the fact that this type of basically good shareholder base decreases the volatility in the stock price. And also, this may spur some innovations. You know, once you're told that you can no longer use child labor, which is in the short run very costly, or you may have to put some refinery to fix up environmental issues, it's costly, but it also pushes you to be innovative, how to basically do things in a much better way and decrease your costs as well. Therefore, the point I'm trying to make is, even though these ESG practices in the short run might be costly, the main takeaway from this paper is that, well, there is hope. If you do this properly, by basically doing good, by doing well, you can be, by doing good, you can do well. That's essentially the win-win approach. But I also have to give you one caveat. This data has been taken from one of the best practice organization, and we might be basically just seeing the very basically best exercise of these basically activities. This might be an upper bound, who knows. But at least it's just showing you that there is hope. Now, the final thing I want to stress from this study, what came out is for these engagements to be impactful, two interesting things emerged while we were basically going over these emails, telephone calls, etc. One is these investors, when they engage with the company, they don't do it alone. Most of the time, they collaborate. And this is a word that I just heard also in the initial basically panel, this collaboration and coordination, if you like. And that's something I want to highlight. And the second thing is the reputation. If the reputation of the companies are at stake, it basically behaves like a carrot and stick mechanism. It incentivizes the companies to do well, and also it basically incentivizes them to avoid from the bad practices. And taken from this collaboration, we now have a new paper called Coordinated Engagements with the same co-authors. And we are drawing upon this wonderful data coming from Principles for Responsible Investment, PRI, which is located in London. And this is founded in 2006, and I have to also owe to Tatiana for this wonderful introductory basically graph on the Sustainable Development Goals of United Nations. Because in a sense, just to give you the framework, this has been supported by the United Nations. In fact, their website is unpri.org. And the UN basically structure for the countries is somewhat basically miniaturized and then applied to the companies. Think it that way. And that has been now the leading network for investors committed to responsible ownership, long-term and sustainable returns. By September 2019, PRI had more than 2,500 signatories from 67 countries representing 80 trillion in assets. That's huge. And what they gave us after a competition, their data from collaboration platform, where they basically invite all these investors to come together. The way I see it is, again, like a WhatsApp platform to bring the investors to come together and talk to each other and then basically share insights and engage with the firms. And we analyze basically how exactly these collaborations are happening, what's the impact of that. And here's the takeaway. An average engagement now is taking 26 signatories to come together to engage with a firm. Each of these signatories, they are quite big companies, but since they are diversified, they only have about maybe 0.1 to 0.5% of the target share. But then if you get 26 of them, then you reach a very sizable ownership of 10% or 15%. Two of these signatories in a particular engagement are domestic, and 24 of them are foreign. And this is going to be very critical because you want to get the insights and resources from all over the world, but then you also need a local basic guy to deal with the company that you want to engage. And that's what has emerged here, that in fact these engagements become very successful and impactful, kind of similar to the active ownership paper, particularly if you have this structure that you have a lead and then you have the supporting basically investors. This is kind of, I liken a bit to the Chinese, this solution I think has been applied in other parts of the life. If you watch these, I think, Chinese celebrations, I often see they have this dragon, and then there's the tail of the dragon, Again, a similar problem, you need a coordination mechanism. Well, there's a guy who has the head, and then there's a lot of supporting guys that's on the tail. You kind of see a similar, I think, a solution there. In the VC industry, you have general partners, limited partners. In the syndicated loan market, again, this model seems to be working quite well. And basically, what works out is that for all of these basic signatories, you want them to be influential. That means you want them to be large, you want them to have a big stake in the company and big exposure to the company. One is basically from the investor's perspective. For them, this company matters. And the other is from the company perspective. Well, within that company, this investor has a lot of votes. And they should have an integrity and basically capability to be able to do that. I think I will just conclude over here. These are the two papers that I talked, and you may download this from these websites for free. This is a logo that I invented, but I have to say I got highly inspired from another logo which says drink responsibly. I just changed the drink with invest, and I'm just now leaving to the next speaker. Thanks very much for your attention.
Brilliant. Thank you, Oguzhan, for bringing alive what can sometimes be a dry topic through your analogies of Tom and Jerry and dragons, and but also sharing, I think, your very interesting research work. And our third final, but certainly not last but not least, is Howard Sherman of MSCI, who I think is also going to give us a link into some of the experiences in the Indian context as well. Howard.
Thank you. Hello, everybody, and thank you very much for the intro, and thank you for the invite to speak here. It's always great to be in the beautiful Guildhall. It's a real treat when you work in London. So I'm with MSCI, and if you don't know the firm, we're not an asset manager, we're actually a service provider. Our main business are indexes, but ESG has become a really increasingly important part of our overall product line, and it's actually the fastest growing. So ESG is quite an interesting area for me to be talking about. I work within the MSCI ESG research team. It's a global research organization with offices worldwide, including Mumbai. And our primary goal within the ESG world is to help align investor objectives with investment solutions. So Tatiana outlined basically the same worldview that we have. If you start with values in the upper right quadrant, this is the traditional socially responsible investing or negative screening. It's investors who want to avoid investing in tobacco companies or alcohol companies. And it's a very valid investment process. It's still used by many, many clients. But by definition, when you eliminate some companies from your potential portfolio, there is a risk that your performance may suffer. So a lot of traditional asset managers instinctively avoid this because they think it's sacrificing returns. But what's been happening in the last few years is the diagram on the left. This is ESG integration. This has nothing to do with eliminating questionable sectors from your portfolio. It's really looking for best-in-class solutions, regardless of what sector it's in. And at a very high level, ESG integration includes assessing ESG risks and opportunities before you buy into a new security, or deciding how to price the security. Some of our clients are actually adjusting the discount rate in their discounted cash flow models before they buy into a new position based on ESG risks. It includes ongoing monitoring, so you know whether the ESG performance of a company is improving or declining, whether it's suffering any controversies. It includes engagement, which we've just heard an awful lot about, and the reason that Larry Fink, who's head of BlackRock, the largest asset manager in the world, has written this letter and made a big effort to publicize it, it's not because he's had a sudden change of heart. It's because it's good for business. It's good for BlackRock. And one of the main reasons is a huge amount of BlackRock's portfolios are indexed. They're passive portfolios. So if you're locked into a position for, in theory, ever, why wouldn't you want to try and improve valuation at your portfolio companies? And that's why the big index providers like BlackRock and State Street and Vanguard have become very, very visible in engagement just in the last few years, because it's good for business. And third, on the bottom right quadrant, impact investing, we've also heard about. This is a desire to invest primarily to make an improvement somewhere and not necessarily for financial gain. It's attracting a lot of attention from, as we've heard, millennials and wealth managers. All three are very valid investment approaches, but you really need to start with what are your objectives, and then you can decide how to use ESG factors to support your goal. MSCI is also very prominent in ESG indexes. We actually supply more than anybody else in the market. So you can see in the graph in the bottom right, the total assets tied to ESG indexes isn't huge compared to the overall market, but you can see the growth rate has just been explosive the last few years, and it really suggests that this is becoming quite mainstream. Now, while it's not on the slide, we're also the ESG arbiter, if you will, of the Bloomberg Barclays MSCI Green Bond Index, the worst named product in the financial markets, but that's part of what we do as well for green bonds. And because I'm here, I also wanted to talk about India specifically for a minute. You know, MSCI has offices worldwide. Mumbai is our largest. So it's a really important part of our business. I talk to the team there every day. The MSCI India Investable Market Index, the IMI, covers 99% of the free float market cap in India. Our ESG ratings, our research products, cover now 222 companies, and we're currently rating more than 800 equity and fixed income funds within India. So it's an important part of our business, clearly. And part of what I do for MSCI, besides governance responsibilities, I'm the commercial liaison for all of our business development people in India and the rest of Asia Pacific. So I see firsthand what's going on. And what's been really telling to me is that until, say, 2 years ago, our clients in India were all part of global banks or global asset managers. So there were one or two people in Mumbai or Pune who were tied into a New York or a London bank. In the last couple of years, we're now servicing purely domestic Indian asset managers and banks who are bringing ESG into their operations. And to me, it's a very historic shift in how the Indian market is looking at ESG issues. So clearly a trend we expect to continue. And what's happening, not just with India issuers, but worldwide, is as more asset owners, more asset managers, banks, insurers, wealth managers start bringing ESG into their operations. A typical investor relations officer or chief financial officer can't dismiss this as something they want to go away. Yet they really have to deal with their ESG profile. So we're getting more and more inquiries from the companies we rate who want to understand how do we look and why are we rated this way. We have a issuer communications team that is available to any issuer. You have free access to your reports and you can check the data we've collected. But one of the points I really wanted to make here is if you're representing an issuer in the room, you should be paying attention not just because your shareholders are asking you about this, but if you really start to bring ESG into the boardroom and senior management, it's good for business. I mean, I think ESG analysis really helps you identify long-term risks and opportunities that traditional business reviews may not pick up. I think it helps instill a different culture within the workforce. MSCI has actually evolved quite dramatically the last couple of years, and our employees are really happy to see more recycling at MSCI, for example. But I think ultimately, the real benefit to you is it will lower your cost of capital. And if you really want to understand that, you should follow what the banks are doing. So we're now working with a number of banks who want to examine the ESG risk in their loan books. And the point is they want to lower the ESG risk. So they may start selling off loans that they deem too risky or not granting loans at all. We're now working with the due diligence department of a number of banks who are looking at ESG risk before they even decide to lend money to a new issuer. And there's a new phenomenon in the market that's, I think, going to have as big an impact as green bonds, and that's ESG-linked lending, where the interest rate charged to a borrower will be adjusted up or down based on their ESG rating, among other criteria. So we've done a couple of these, and the interest rate adjustment isn't huge. It's 2.5 basis points up or down based on whether the ESG rating declines or falls. But what happens is when these issuers come to market with a new ESG-linked loan, it gives them bragging rights. It says, look, I'm good enough to have arranged a syndicated credit facility with 21 banks globally that are supporting my ESG-linked loan. And again, this is all about your cost of capital. And I think this is why this isn't just a feel-good or reputational issue. This is really how I think companies need to manage going forward. So we offer a number of ESG indexes, one of which is the MSCI ESG India Leaders Index. This index is tried to mirror the MSCI India Index. And what we're doing is overweighting companies that have a higher ESG rating. And as you can see from this graph, the Indian companies with superior ESG performance, at least in our view, have outperformed the benchmark. So again, traditional negative screening still has an association with negative returns. It's really not the case at all. When you look at ESG integration and best-to-class approach, you can actually not just avoid losses, but outperform in some cases. But it's not to say that everything is rosy in India. We have a very dedicated corporate governance research service. This is from our country report for India. We have serious concerns about governance risk in Indian companies. One that gets a lot of attention in the press is succession planning issues for family-controlled companies. I think most people would think that's the number one governance risk at many Indian conglomerates. But we also have concerns about overall governance quality, audit committee composition we find lacking at a lot of Indian companies. There are lots of controlling shareholder concerns, related party transactions. I won't go into a lot of detail, but within the ESG framework, you ask me, if you don't get governance right, if you don't have the right people on your board, you don't have the right governance processes, it's very difficult to get everything else right that's expected of you. So we place a lot of emphasis on governance quality in our own research. And I know we don't have a whole lot of time, but I just want to try and provide a little more background. Why is all this happening? Why is ESG suddenly exploding in different markets and different parts of the financial system? Well, I think there are 4 different reasons, which I'll explain in a couple of different slides. One is that, ESG scandals can cost you a lot of money these days. And, we referenced the Exxon Valdez spill, which was just a horrible, horrible incident in the United States, Gulf of Mexico. But it didn't really affect Exxon's stock price all that much. If you look at what's happening now, these scandals very quickly will hammer your stock price if you're involved. So one aspect of ESG is trying to avoid these calamitous incidents which will lead to stock price declines and the inevitable lawsuits. There's also more and more evidence that ESG can help financial performance. We've already heard a bit about this. I won't belabor the point anymore. But, a lot of this is also happening because the world's largest asset owners, pension funds, sovereign wealth funds, insurance companies, these are the classic long-term investors, and they know that ESG risks and opportunities are going to affect their performance and risk profile forever. So they're the ones who have really started to pay attention and put pressure on their asset managers. And a number of them, including the United Kingdom's Environmental Agent Protection Fund, have decided to move a lot of their portfolio to ESG-adjusted indexes. So in addition to green bonds, it's really an effective way to move a lot of capital very quickly towards ESG solutions. So I would expect to see more and more of these asset owners shifting benchmarks to ESG-linked strategies. And last but not least, if you really want to look at ESG across a large portfolio, you need good data. And it's not to toot our own horn, but it's a very specialized discipline. If you're relying strictly on corporate disclosures, you're not going to get enough information. And actually 45% of the data we use in our ESG research services doesn't come from corporate disclosure. We're looking at media news sources, we're looking at NGO disclosures, we're looking at academic databases, and it takes a lot of discipline and a lot of data scrubbing to make sure you've got the right information to build up into ESG ratings at the end of the day. And that's what's been happening in the last few years. We and other providers have actually, I think, gotten a lot better at our ESG information, which is why the big banks, insurers, asset managers, wealth managers are now able to bring this into their houses more than they could in the past. And I won't go into this because we don't have time, but lots of different ways of approaching ESG, and my takeaway is for anybody from India in the room, I've seen great progress because I deal with the market every day, but there's lots of room for improvement, starting with the governance side, so go back and tell your bosses, your employees, your colleagues, keep up the good work. And that's it for me. Thank you.
Great. Thank you, Howard, and I'd like to thank all the panelists for their contributions. Time is pressing, so we only have a few more minutes left, and I was hoping to open it up for Q&A. We will do that if we can, and if I can persuade my panelists to give short, snappy answers, having spoken already at length. So if I can take the liberty of the chair to maybe ask the first question, which is the same to all the panelists. If we hold this panel again in 5 years' time, what are the biggest changes that you would expect to see in the realm of sustainable investment? Tatiana.
Perfect. So I think Kevin said everything we've just spoken about with all the panelists. What I would expect to see in 5 years' time, there are going to be 3 changes in my view. First of all, what we haven't really touched upon is the difficulties and challenges around investing in sustainable investment products, which are both institutional and retail investors face. And here, UBS actually have done a very nice paper last year looking at just that, where we've identified that improving clarity and improving standardization across various terms, both used by the industry and by companies in their disclosures, could greatly help investors to get further involved in this sector. And if we were to have this panel in 5 years' time, I am strongly hoping that that is not an issue that we will be discussing in great detail. Secondly, and coming from this, I would then expect a much bigger involvement from the retail clients in this space. As of beginning of 2018, we've seen around a quarter of all the sustainable investment industry assets being invested by retail clients versus 75% by institutional investors. And I would expect the retail share to grow higher. And finally, and on the point which Howard just finished here, his presentation, I do expect a number of instruments and very interesting ways for investors to get involved in this space to grow exponentially in 5 years' time.
Jean.
Very briefly, the ESG ratings at the moment, there is a huge disagreement. If you just look at their correlation, it's rather low. I am hoping that there will be a bit more, obviously not exactly the same, but there will be kind of more, basically, convergence. And second thing is, the study shows at the moment, the good companies in the developed, basically, world is getting better and better. And then there's kind of a bit of a polarization. I'm hoping the emerging countries will pick this up and come up.
Howard.
Well, on the corporate side, we'd expect to see more integrated reporting. So rather than a separate CSR report and then the annual report, we expect to see many more companies embedding ESG into their basic operations and strategy, and that means putting it into the annual report and quarterly reports. Certainly expect to see more ESG-linked lending, and I wouldn't be surprised, in addition to green bonds, to see green equity, permanent capital for social investing purposes, not just lending purposes.
Right, what we're going to try and do so that we don't run over is we'll go to some questions, but I'll take maybe 3 questions all at once, and then I will allow the panel to pick and choose what they answer. So I think if we go to Gautam, just wait for the mic and maybe briefly, quickly introduce yourself.
Yeah, Gautam Swarugi. Just want to ask, how do you measure the quality of an ESG and to avoid the concept of a hype or bubble pricing?
Or maybe greenwashing too. Anybody else? Yes, Lopa.
Yes, thank you. I'm Lopa Patel. A question really for Howard. What are you seeing in terms of government intervention? Is it helping ESGs or is it hindering them?
And we'll take, if there is anybody with one more final question, otherwise we will put those 2 questions to the panel. Maybe I'll start with Howard.
The question is government intervention helping or hurting ESG? Well, it depends on the country. I'm dual US, UK citizen, so looking back in the United States right now, it's clearly hurting. I mean, there's a lot of political pressure and pressure from the business community to clamp down on all this. And Trump's administration is putting a lot of pressure on the Securities and Exchange Commission to wind back a lot of regulation. It's putting pressure on the United States Department of Labor to roll back rules concerning fiduciary responsibilities that a few years ago allowed ESG considerations by pension fund trustees. The Trump administration is trying to roll that back as well. So not good at all. But I look at the rest of the world, I see a lot of positive developments. So, I mean, the UK, we just heard, is clearly in the vanguard. The European Union has spent the last couple of years trying to develop new rules and taxonomy for ESG products, and I think that will continue the next few years. Looking at Asia Pacific, the Hong Kong Monetary Authority has very visibly gotten way behind ESG and is trying to use its influence as a regulatory authority to promote change throughout Hong Kong and Greater China. The Japanese government, a couple years ago, embarked on a very serious initiative to use ESG to improve performance within the Japanese market. And the largest pension fund in the world, GPIF, the Japanese government pension fund, has gone from nowhere on ESG to becoming one of the most outspoken advocates of ESG investing. So when I look outside the US, I'm very encouraged to see governmental agencies doing the right thing and pushing the right agenda. Back in the US, not so much.
Oguzhan, do you want to comment?
Maybe just to add, the Norwegian oil fund is also related to the government, and many other now sovereign wealth funds are paying attention. And related to the question on the ratings, I think you touched upon a good point that I was going to mention. European Commission is now working on taxonomy of these ESG-related basically ratings, and hopefully within 5 years, maybe we may see an improvement. My studies, they don't rely on ratings. They're just looking at incremental improvements based on some scorecards, measures that has been put. Just if you're basically polluting this much, we want you to decrease it by 10% in the next 2 years, etc. that might be another basic way to tackle these issues.
And just to add to all these points on the first question, in addition to regulatory oversight, which we've just discussed, another thing one can do to sort of avoid greenwashing, as Lord Gadhia mentioned, is to put very rigorous processes internally around these issues of ESG and how the ESG processes are integrated into the investment process. And that is one of the ways to also convince yourself, regulators, and also your clients that you're taking it very seriously.
Okay, so our time is up. I think it's been a great discussion. We've covered actually quite a lot of ground in the last hour or so in an investment area which is clearly burgeoning in terms of both scale and scope. So please join me in thanking all the panelists and wish you a great conference. Thank you.